Good afternoon to everybody in Israel, and good morning to you, Jessica, and to anyone else in the US. Thank you for joining us on this webinar today. We'll talk today about granting equity, mostly options and RSUs, to US residents and citizens. It's a very relevant topic for Israeli startups, granting equity to its US citizens or residents. Just to introduce ourselves a little bit, my name is Shir Sela Pinchas. I'm a partner at the high-tech department at Shibolet Law Firm. I lead the equity compensation practice at Shibolet, and I have here with me Jessica Lutrin, partner at Pillsbury Law Firm and Pillsbury's executive compensation benefit practice group leader. On a personal note, I've known Jessica for a little over 3 years. And to anyone who doesn't know Jessica, she's really one of the best in the field of equity compensation. Extremely professional. I always enjoy working with you. And I know that this presentation is going to be very informative, very interesting for any startup that's granting equity to US grantees. So before we dive in on this hot topic, just to give you the framework, we have a very, very intense presentation on granting options to U.S. residents. We'll start with an explanation, a little bit about the different types of equity awards. Then we'll dive a little further on ISOs, on 409A rules. And the more you stick around with us, the more complicated it will get. So that depends on your appetite. We got 83B, we got 280G, we got a lot of interesting numbers, sections from the Internal Revenue Code. We'll try to simplify that for you. And we invite you to send us questions through the Q&A or the chat. We'll collect questions throughout the webinar and try to answer them throughout or in the end. So please do feel free to ask any questions. Jessica?
Great. Thank you, Shir, for that introduction, and welcome everyone to our presentation. We're grateful that you're going to spend the next hour with us. As Shir said, this is going to be focused a little bit more on high level or detailed considerations than the basics. But if you have any questions about the basics, as Shir said, please don't hesitate to submit them in the chat, and we would be glad to ask them. So the first place that we want to go is talking about the different types of compensatory equity awards that can be granted. We thought this would be helpful just to level set so that we make sure we're all on the same page in terms of understanding what we will be talking about. Generally, in the US, there are 3 types of equity awards that are granted to employees, directors, independent contractors. The first type is a stock option. And a stock option is a right to purchase shares, generally of common stock, at a fixed exercise price at some point in the future. The general rule of thumb in the US, and we'll get into that in a little more detail, is that the exercise or strike price of the option must be at least equal to fair market value of the company's stock on the date of grant. And there are certain exceptions to it, and we're certainly aware of instances where companies violate that rule, and it can be corrected in certain situations, and we'll talk about that in a little bit. Typically, stock options are subject to time-based vesting conditions, meaning that you need to provide services in order to vest in the option. In the US, a very common vesting schedule is a 4-year vesting schedule with a 1-year cliff, meaning that no options vest until at least 12 months of services have been provided. And then the remaining option vests over the 36 months, either in monthly or quarterly installments. Occasionally, we do have options that are subject to performance-based vesting, and you have a lot of flexibility in terms of how you design performance-based vesting. It could be linked to, for example, the attainment of a milestone. So, if you're an aerospace company, you could grant someone an option and say, this will vest when we launch our first rocket. That would be entirely permissible in the US. You could also tie performance-based vesting to a qualified financing. So, for example, you could say, if we raise $10 million within the next 3 years, this option will vest. All of that works in the US and does not violate the US tax rules regarding stock options. One thing to bear in mind, which is not a deterrent for accelerated vesting, but just to keep in mind, is that there is a provision of the US tax code which is referred to as Section 280G, or sometimes it's referred to as the Golden Parachute Rules. And these rules apply to both public and private companies who are experiencing a change of control. And in that situation, if certain what are known as disqualified individuals, which are highly compensated employees, executive officers, or significant shareholders, receive certain compensatory payments that are contingent on the change of control, if the value of those payments exceeds 3 times their average annual compensation for the last 5 years, then they could be hit with a 20% excise tax on the value of those payments, in addition to ordinary income tax, unless in the case of a private company only, the shareholders vote to approve those payments. And the types of compensatory payments that would be taken into account for purposes of the Section 280G analysis include accelerated vesting of options. They also include transaction bonuses, severance, and anything else, new employment agreements, etc. But a key component of the 280G analysis is accelerated vesting. In my experience, it does not prevent companies from accelerating vesting. It's just something that will factor into your analysis. As I'm sure you're aware, there are 2 types of stock options: incentive stock options and non-qualified stock options. We'll go into the differences between the 2 in a little bit, but generally at a high level, incentive stock options are statutory stock options, meaning that they need to satisfy certain statutory requirements in order to get beneficial tax treatment. The second type of equity award that we'll be talking about today is a restricted stock award, or an RSA. That is basically the grant of actual shares to an individual that is subject to forfeiture or a right of repurchase. So someone would get actual shares that would be subject to a vesting schedule that would lapse over a period of time. And like with stock options, that vesting schedule or that right of repurchase could lapse based on time, so the provision of services, or it could lapse based on performance criteria. Unlike a stock option, a restricted stock does not have any exercise or strike price. A restricted stock is also not subject to Section 409A, whereas stock options are. And the benefit of a restricted stock award, again, which we'll talk about in a little bit, is that a holder can make what is known as a Section 83B election to pay their ordinary income tax at the time of grant, which can be very beneficial if you grant a restricted stock award early on and it's not worth a lot. The third type of equity award that's very common in the US is what is known as a restricted stock unit, or an RSU. That is a right to receive shares in the future. So unlike a restricted stock award, the individual is not actually receiving shares. They won't be considered a shareholder for purposes of voting. They'll simply have a right to receive those shares at some point in the future when the RSU vests. For private companies, it's very common to grant what is known as liquidity contingent RSUs. And that is basically an RSU that vests based on the satisfaction of 2 conditions: a service condition, so the individual needs to provide services, and then the occurrence of a liquidity event, either an IPO or a sale. Again, we'll talk about this in a little bit, but that is a very common structure for later stage private companies in the US. Unlike stock options, there's no exercise price and there is no strike price. The downside of a restricted stock unit is that there is no ability to receive capital gains tax treatment. So it will be taxed at ordinary income when the individual receives the shares. And I'll pause there, Shir, to see if you have anything to add before we go to the next slide.
Sometimes we see companies being incorporated in Israel thinking about doing the 83B election when they incorporate. And do you think that makes sense, even though the founders are Israeli, they are not thinking about moving to the US yet, but they do have a restriction by virtue of their founders agreement, a certain repurchase mechanism that's actually a restriction, like a restricted share. So do you
Right.
think that makes sense? Do you think that's recommended?
Yeah, so great question. That's what you described is the same as how it would work for a US founder, is that their founder shares would be subject to a right of repurchase that lapses over a period of time. In the US, a founder would absolutely make an 83B election. For non-US founders, typically what we recommend is that if that individual thinks that there is a chance that they could move to the US at some point in time or become a US taxpayer, we would recommend that they make an 83B election. The one wrinkle is that there is an input on the 83B election form for the individual's taxpayer ID, which in the US, if you were a US citizen or resident, would be your social security number. But what we recommend is in that place you can just insert none, because a non-US founder is unlikely to have a social security number. And then if you ultimately become a US taxpayer or you move to the US, you could submit or send a letter to the IRS saying, I made this 83B election and here is my social security number. So I think that it is a good idea, and it's something that non-US founders or anyone outside of the US who's receiving restricted stock should seriously consider. Because if that stock does vest when you are a US taxpayer or providing services in the US, the tax consequences could be catastrophic. So certainly no harm in making the 83B election. And if it doesn't apply, it doesn't apply.
And you can do it today, you can do it digitally,
Yes.
just online. You don't have to send a letter to some box office somewhere.
Exactly. And we'll talk about that in a little bit, but this is a very recent development in the US, and it's really exciting because exactly as you said, before you had to mail it by a snail mail, and it was a very manual process. So, it took the IRS a long time, but finally you can make an electronic 83B election. Okay, so moving on to the type of individuals who are eligible to receive an award. And this comes up very frequently in the US because we often see ineligible service providers receiving the wrong type of award. With respect to an incentive stock option, that can only be granted to an employee of a corporation. And generally what we recommend is that it should be a US employee. If someone is outside of the US, we would recommend that they receive a non-qualified stock option. A common topic that we encounter is, especially with our startups who use what are known as professional employer organizations or PEOs, whether the employees who are co-employed by a professional employer organization can receive an incentive stock option. And the general rule of thumb is yes, because as long as those individuals are have a bona fide employment relationship with the actual company which is issuing the incentive stock option, that should work under the ISO tax rules. It becomes more complicated when you're dealing with an employer of record outside of the US, because in that situation, the individual is actually employed by the employer of record. With a PEO, it's a co-employment relationship, meaning that the individual is employed by both the PEO and the company, and the PEO is only the co-employer for purposes of payroll, benefits, and tax withholding and reporting, but the company continues to control the employee and has the ability to direct them, give them instructions, make decisions with respect to hiring and firing. But with an employer of record, that's not the case. The employer of record is actually the employer. So in that situation, it's unlikely that an individual who's employed by an employer of record would qualify as an employee for purposes of the ISO rules. So for this reason, as we said, non-employees such as consultants, advisors, or directors, if you're granting them options, they should receive non-qualified stock options. You could also grant them restricted stock awards or RSUs. The other requirement that you need to bear in mind in deciding what type of equity award to give to an individual is Rule 701. And this, we'll also talk about this in further detail, but Rule 701 is something that I think is often overlooked, both by US and non-US startup companies. So in the US, in order to grant a compensatory equity award, if you're a public company, you just need to comply with the securities rules by making a filing with the Securities Exchange Commission and becoming a reporting issuer. So that's a somewhat straightforward process. For private companies, it's different. They need to find an exemption from the securities requirements. And the most common one, or the standard one that most companies rely on, is Rule 701 for compensatory equity awards. And that has a variety of requirements, but one of the requirements is that the equity awards can only be granted to employees or natural person consultants or advisors who are rendering bona fide services, so not providing capital raising. What that means as a practical matter is what we see companies do is that if you have, for example, a consultant who also has their own LLC, you would grant the consultant in their individual capacity the equity award, and then provided it's permitted under the terms of your equity plan, they could then transfer their equity award to their LLC. And that has never been challenged under Rule 701, but that's what we would expect would work under 701. And as I mentioned, you also need to review your equity plan to make sure that awards can in fact be granted to entities, or what the requirements are. At least our model equity incentive plan says that if an award will be granted to an entity, that's fine, but you cannot rely on Rule 701, and you need to make sure that another securities exemption is available. And there are a variety of securities exemptions that you may be able to rely on to grant an award to an entity. The other thing that comes up for us frequently, which I understand from conversations with Shir is likely not an issue in Israel, is that almost all US equity incentive plans contemplate that equity awards can only be granted to current or prospective employees, consultants, advisors, or directors. They do not contemplate that a former employee or a former service provider could be granted equity. So that is something that I think is important distinction and important to bear in mind. Share anything to add before we move on?
Yeah, so if I'm an Israeli startup and I'm granting options to a bunch of Israeli grantees, and I have this one US consultant, I'm exposed to compliance to comply with US securities laws, right? I need to
Yes,
make
that's
a
correct.
filing. And what happens if if I fail to do this notification or filing to the relevant state?
Yeah, so a great question. Technically, if a company fails to comply both with the federal and state securities requirements, the individual has what is known as a rescission right, meaning they can go to the company and say, you need to make me whole for this equity award. You need to, if I exercised it because I had an option, you need to refund my exercise price, and you need to pay for any damages that I have suffered as a result of this equity award. As a practical matter, the only damages an individual may suffer is if there has been a significant drop in the stock price. Also, as a practical matter, in my experience, companies do not conduct rescission offerings. They do not go out to individuals and say, oops, we failed to comply with these laws. You have a right to request rescission of your equity award. Most employees are not sophisticated when it comes to these rules, and so would not bring a claim. And if your stock price is doing well, they're unlikely to say you need to take back this equity. So that's what happens as a technical matter. As a practical matter, I think that compliance in this area is pretty lax. And we tend not to see a lot of actions by employees We do occasionally see some requests for information or follow-ups at the state level, but that's generally only when someone has made a filing and put the state on notice that they need to, that they have granted equity awards. So there's not a lot of enforcement in this area, not to say that's a reason not to comply with it, but a lot of companies, especially startup companies which want to focus their resources on other things, tend to not deal with this initially, and then as they continue to grow and have more time and money and resources, will then clean up their compliance in this area.
But then we also have some states that, if I remember correctly, you don't have to file if you have less than, I don't know, like 3-5 grantees. And there are other
Yes.
states that you have to file if you have even one, right?
Right. So the states, unfortunately, just like with many laws in the US, every state has its own law. So some states say if you comply with Rule 701, you're good, there's nothing else you need to do. Other states say you need to make a filing or you need to submit a notice to us in order to perfect your Rule 701 exemption. There are certain states like New York and California that basically disregard Rule 701 and have their own set of requirements, where you would have to make a filing as well as pay a filing fee. So in New York, the filing fee, I think, is $410, and in California, it can be as much as $2,500. And then you're entirely correct. There are certain states that say if you are making awards to individuals below a specific number, then that will be considered, we don't require a notice, you don't have to make a filing, you don't have to pay a fee, but if you go above that, then certain notice or filing requirements would be triggered. Okay, great. So moving on to corporate approvals. Again, this is an area where we see a lot of non-compliance. And in fact, I'm actually working with a US startup client. It's more than a startup. They've been around since 2018, and they have not papered any approvals for their equity award. So that is somewhat problematic. But the general idea is that when a company is granting equity awards, whether it's options, RSAs, or RSUs, to any of its service providers, those awards need to be approved by either the board of directors, or if the company has a compensation or remuneration committee, the committee. And the approvals could take the form either of a unanimous written consent that is circulated electronically to the members of the board or the committee, or if the board is going to have a meeting, they can just adopt resolutions approving those equity awards. Typically, what we like to see in the resolutions or the written consent is authorizing resolutions saying, we hereby approve the awards set forth on a schedule. And it's on that schedule that we want to see a variety of information. In particular, we would like to see, or, you should include the recipient of the award, so the name of the individual, the number and class of shares that they're going to be receiving. If it's a stock option, the exercise price, then the type of equity award that they're receiving, so either ISO, ENSO, RSA, or RSU, any vesting or acceleration terms, and if there are any special terms that are applicable to the equity award. So sometimes companies will grant a stock option with a post-termination exercise period that is longer than just the typical 90 days. And it's very important actually for stock options that these requirements or these terms are set forth on the schedule. And the reason that is important is because, as we mentioned at the outset of the presentation, there is a rule in the US that the options must be granted with an exercise price at least equal to fair market value on the date of grant. And so then the question becomes, well, what is the date of grant? And the general idea in the US is that the date of grant is the date on which all corporate actions have been taken to determine kind of the main terms and conditions of the option. And so what you see listed on the screen is included or would constitute the main terms and conditions of the option. So it's important that we establish a grant date by having the approvals approve all of these features of the options. In addition, if you're granting an option, you also want to have a series of resolutions that would approve the exercise price. And we'll talk about this in a second, like how do you determine the exercise price? But even if you have a 409A valuation that has been previously approved by the board or the compensation committee, it's important in your resolutions to acknowledge that and say, we had a 409A valuation as of X date. There have been no changes since we got this valuation, and the board or the committee hereby determines the 409A valuation to be this fair market valuation. So that's an important piece that is also often overlooked in resolutions. It's also possible in the US for a board or a committee to delegate to an officer the ability to grant stock options. This doesn't happen with a lot of frequency, but we do occasionally see it. So it's often the power to grant stock options will be delegated to the chief executive officer. Under Delaware law, this is permissible, but there are certain parameters that need to be complied with in order for the delegation to be valid. So, for example, any delegation needs to specify that the officer cannot grant options to themselves. It also needs to specify the maximum number of shares that the individual can delegate and the period of time or the term during which they can make those delegations. So a delegation is permissible, but you would want to see, again, resolutions approving the delegation and setting out these parameters. In the situation where a company has not adopted the approvals necessary for their equity awards, or they've delegated the authority to grant the equity awards to executive officer, but the delegation is defective, there is the ability under Delaware law to ratify defective corporate acts. And there are effectively kind of two pieces to it. The first one is a board resolution that the board would adopt that says, we recognize that we failed to do this properly. We are now ratifying what we've done in order to make sure that these approvals are valid or the delegation is valid. And then the second part of it, which gives some companies heartburn, to be honest, is that you have to give your shareholders notice that you are ratifying these defective corporate acts. So as you can imagine, companies do not want to put their shareholders on notice that they failed to do something correctly. But if you comply with those two steps, it effectively blesses these defective corporate actions. So there can be a lot of use or power with taking advantage of this ability under Delaware law. Sure, anything to add before we move on?
No, it's interesting. And Israeli wouldn't do that. Typically, the board is the one that has the authority to grant awards, or a committee comprised of board members. But that's interesting. We do have some companies that are incorporated in the U.S. Under Delaware law, and so it's good to note.
Yep. Okay, great. Okay, so we've alluded to this topic quite a bit since we started our presentation, and this is a topic that is very technical and comes up very frequently. And the general idea, as we've mentioned a couple of times now, is that options, both ISOs and ENSOs, must have an exercise price that are at least equal to fair market value on the date of grant. And for public companies, that's a pretty easy determination because their stock is traded on a stock exchange. And so they can just look at their stock exchange and say, the closing price on the date of grant was X, and that is the price that we're going to use for purposes of determining or setting our exercise price for our options. It's a little bit more complicated when it comes to a private company. The Section 409A rules basically say that a private company can use any reasonable valuation methodology in order to determine the exercise price of their options. For early stage startups, so within the first 6 months to a year, what we tend to see is the board simply determines the fair market value. And in that situation, the companies generally do not have revenue, they do not have contracts, they do not have assets, and so the valuation is determined by the board to be the par value of the stock. Because in the US, the rule is that a stock cannot be purchased for less than par value. So when companies are just starting out, they'll typically set their fair market value as par value. Then as the company continues to grow, what we tend to see is that they will then engage an independent valuation expert to run their fair market value determination. And the independent valuation expert will publish a report that says, this is what your fair market value is. Here are all the factors that we looked at in coming up with your fair market value. So I'm sure some of you are familiar with the cap table management platform known as Carta, which is very, very popular for US companies. I would say almost all of our companies use it. Built into their platform is the ability to get a 409A valuation every 12 months. Because the general rule is that if you're getting a valuation from an evaluation expert, you can rely on it for 12 months unless there is a material intervening event which would render your valuation stale. And so what we would consider in the US a material intervening event is a corporate transaction, such as an M&A event, if a company does a financing, if there is a significant litigation, or if a company all of a sudden gets significant contract, which is going to increase their revenue, for example. In all of those situations, we would strongly recommend that a company get a new valuation. So what is common with a financing, for example, is a financing will happen, and then following the financing, once it's closed, the company will go to their valuation expert, tell them about their financing, and get a new valuation, which they can then use for the remaining 12 months. In addition to getting a new valuation when you have a material intervening event, as a company is gearing up for an IPO, we would also recommend that they get more frequent 409A valuation. So if companies are very significant or very large, probably makes sense for you to get a valuation every 6 months. And then in the 12-month period, about in the lead up to an IPO, you should be getting a 409A valuation likely every quarter. If you do not have a 409A valuation because, for example, it expires and you've got to get a new one, which happens very commonly, in that situation, we would recommend that you hit pause on granting any options or allowing employees or your service providers to exercise their stock options. The one exception to that is that if they have a stock option that is going to expire because they're in their post-termination exercise window and they need to exercise. In that situation, we may say, estimate the 409A valuation, or you can, if you think you have a sense of what your 409A valuation is going to be because it's in process, you can use that. But if you do not have expiring options and you do not have a current 409A valuation, the general rule of thumb is do not grant options and do not allow employees to exercise their options.
So,
Go ahead, Sharon.
I'm just picking up a few questions. Can financing round price be a good indication to base on as the fair market value? And can it be 60% discount on the financing round? Does that work?
Yeah, so it's a great question. Yes. So generally, the financing, the price for the financing is going to be for a company's preferred stock, whereas the valuation that you're getting for 409A is for common stock. And the general rule of thumb, no, it's not scientific, but the general rule of thumb is that your common stock fair market value will be on a 70 to 80% discount off of your preferred stock. So if you wanted to be conservative, you could absolutely use a 60% discount, with the understanding that that's probably going to be a little bit higher than where your 409A valuation for your common stock would work. But yes, that is a great indicator of what your new valuation for your common stock will be.
But if I want to be more conservative, I should just use the price of the round, right?
Yeah, that would be the most conservative. That will penalize your employees in the sense that they would have a exercise price that is considerably higher than your common stock. So it will be much harder for them, for those options to become in the money, but you could do that in theory.
And what about a good faith determination that a company, if they can make a decision what they think their fair market value is and sort of an internal valuation?
Yeah, so you can do that. And we do have companies make that determination, especially in the situation where they have an expiring option and they don't have a good 409A valuation because they have a financing coming up. They will make a good faith determination. We always encourage companies to be conservative. So if they're going to do it, they should estimate it a little bit higher than where they think it's going to come out, because you'd rather be in the situation where you've granted an option with an exercise price that's higher than your fair market value than is lower than your fair market value, because it's much easier in that situation to just reprice the option. You can reduce the exercise price to the fair market value. Then if you have a discount option with an exercise price less than fair market value, that can actually trigger significant adverse tax consequences under the code. And maybe that's a good segue to our next topic, which is the discounted options. So in the situation where a company grants an option with an exercise price that is below fair market value, that does not work under US tax rules unless the option has been structured to comply with 409A. So in that situation, a company could make the decision to say, we're going to grant the option with an exercise price that's less than 409A, and we're going to structure it to comply with 409A. A 409A compliant option does not function like a traditional option, meaning an employee cannot exercise it whenever they want, provided it's become vested. And the downside of a 409A compliant option is that it cannot participate in a secondary sale because you can't exercise whenever you want. How a 409A value compliant option works is that it can only be exercised on certain permissible exercise events. And that is typically the earlier of a fixed date, a change of control, or a separation from service. So you would grant the option, it would have a vesting schedule, and it would say, this option can be exercised on the earlier to occur of a fixed date. I'm making it up, January 1, 2028. When you are terminated for any reason other than for cause, or when a change of control of the company happens. And then if we get to January 1st, 2028, and you haven't experienced a separation from service, or a change of control has not happened, you need to exercise that option or it will go away. So you can do 409A compliant options, but it obviously they have some downsides. And it can be hard to explain to employees what they're receiving. In the situation, oh yeah, go ahead.
Then how deep can the discount be? I mean, can I just if I do this 409A compliant options, can the exercise price be the par value of the share?
So it's a great question, and I would say that practitioners very much differ on this. For example, in the UK, it's very common, as you may be aware, to grant what is known as nil cost options, which is basically an option with an exercise price that's like equal to par value.
We do that in Israel. We really like that.
Right. And I can completely see why
Please
you would
don't take that away from us.
So practitioners differ. Some say in that situation, it's effectively like you've granted restricted stock because the discount is so steep, it's almost like the individual is just receiving stock. And so you would tax it like a restricted stock award, meaning it would be taxable when it vests, unless you make an 83B election, and then it would be taxable on ordinary income. So some people say that doesn't work. Other practitioners say, no, that can work as long as it's structured to comply with 409A. So I think the better approach is to treat it the former, to say it's likely like restricted stock. And accountants will certainly have a position on that as well. So we would always recommend that if that is something you want to do for your US folks, to speak to your accountants to make sure that the tax and the accounting treatment is aligned. But the general rule of thumb that I like to tell clients is if it's more than a 90% discount, it probably doesn't work. So you can do a pretty steep discount, but 90% is where we would draw the line. And again, this is all, if the IRS were to come in and look at this and conduct an audit, which I think is also unlikely, but if they were to do it, they may take a different position as well. But that's kind of the general guidance that we give our clients. So in the situation where a company has granted a discounted option, and it does not comply with 409A, that will trigger adverse tax consequences under 409A. And they can be pretty dire, unfortunately, and the option holder, the actual individual, will suffer those tax consequences. So how it will work is the option will then become taxable at vesting versus exercise. So typically the way that an option is taxed is that when you exercise it, if it's a non-qualified stock option, that's when you will pay tax. And that's great because that allows an individual to control the time that they want to pay tax by determining when they want to exercise their option. But if it's a discount stock option that does not comply with 409A, whenever it vests, you'll pay ordinary income tax, and you will pay ordinary income tax on the spread or the difference between the fair market value at the time of vesting and the exercise price. And you will pay that for each year that the option remains outstanding and vested. So if you have an option that's outstanding for 10 years and it's vested for 5 of those years, for 5 of those years, you should be paying ordinary income tax each year on the difference between the fair market value and the exercise price. And that can become very expensive very quickly. In addition, certain states like California, of course, California, have additional taxes that you would have to pay as a result of it. And then the option will not qualify as an ISO, it will only qualify as a non-qualified stock option. And the company, the issuer of the option, would have certain tax withholding and reporting obligations, but the holder of the option would obviously have their tax consequences would be far worse than any tax consequences that the company would have. There is the ability, however, to correct a discount stock option. The IRS has a formal correction procedure that is available, but there are very specific requirements that need to be satisfied in order for a company to take advantage of it. And sometimes those requirements are so prohibitive that a company is excluded from taking advantage of the correction procedure. The most prohibitive requirement is that for an insider, which is a director, an executive officer, or a 10% stockholder, you can only correct the discount stock option in the year in which the option was granted. So if you inadvertently grant to your CEO a discount stock option in 2025, and you discover this in 2026, you unfortunately cannot rely on this IRS correction procedure to fix the option without any penalty. If, however, you granted it to a rank and file employee, that would be fine. If you discovered it in 2026 for an option that was granted in 2025, you can correct it. So the general idea is that for an insider, which is an executive officer, director, 10% stockholder, you can only rely on the correction procedure for the year in which it was granted. And then for everyone else, you can rely on the correction procedure up until the end of the following year. Other requirements of this correction procedure is that the option cannot have been exercised. The mistake needs to be inadvertent, so it cannot be a deliberate mistake. And then if the option is corrected in the following year, you do have to there's certain tax reporting by both the employee and the employer. There's also reporting in the year in which it's discovered by just the employer, but there will be an additional tax reporting obligation for the employee if you correct it in the following year. So it is available. It's something that a lot of our companies in the US do take advantage of. But if you think that there is a risk that you have granted a discount stock option, absolutely recommend that you go ahead and look at that ASAP, so that if you have granted the stock option this year or last year, you could correct it as soon as possible. Share any comments or questions before we move on?
Yeah, we've elaborated on that. Maybe we'll go a little bit through the ISO requirements, because I want us to have time for all of the slides.
Oh, yeah. I will start to speed up. ISO requirements. So as I mentioned, ISOs are a creature of statute, which means they have very specific requirements that have to be satisfied in order for the option to qualify as an ISO. Those requirements need to be satisfied on the date of grant. So the moment you grant the option, you need to have all of these requirements in place. If you fail to meet any of the requirements, the option will default to an NSO. So as we mentioned, an option can only qualify as an ISO if it's granted by a corporation, so not a partnership, a corporation to an employee. It can also be granted to a prospective employee. So if you know that you have an employee starting 2 weeks from now, it would be fine to grant them an ISO. You would just need to include language in your board approval or your resolutions that we're talking about that says, if the exercise price increases between now, or the fair market value increases between now and the date that the individual actually starts employment, then we will use the higher fair market value as the exercise price. And so that leads us to the next requirement, which is that the exercise price has to be at least equal to fair market value on the date of grant. So when we were talking about the 409A compliant options, which are options that have an exercise price less than 409A or less than fair market value, those will never qualify as an incentive stock option. Other requirements is that the plan, the actual equity incentive plan, needs to satisfy certain requirements. So it needs to include a maximum limit on the number of shares that can be granted as an incentive stock option. That can be same as your share pool, or it can be a separate ISO limit. The plan needs to have a 10-year duration. And then the plan, as well as certain amendments to the plan, which would be any increase, for example, to the share pool, needs to be approved by the stockholders within 12 months, either before the board approves it or 12 months after the board approves it. So the stockholder approval requirement is a very important requirement. In addition, an option will only qualify as an ISO if it meets the $100,000 annual limit per employee. And what that means is that an option, so the way that you calculate the $100,000 is you take the exercise price times the number of shares. And as long as that $100,000, you calculate it kind of per calendar year. So as long as the number of options that is vesting per calendar year per employee is $100,000 or less, then it will qualify as an ISO. And you have to take into account all of the ISOs that the individual is granted for purposes of calculating the $100,000 limit. So just to take a very simple example, if I was granted an option to purchase 100,000 shares and the exercise price was $1, if you granted me that award and the full amount vested in a calendar year, that would qualify as an ISO. But if you granted me an option and to purchase 500,000 shares and the exercise price was $1, in order for that option to qualify as an ISO, you would need to effectively have that option vest over 5 years, and $100,000 would vest each year. What's common in the US is companies just stick with whatever vesting schedule they want to use, and then any excess in excess of that $100,000 will just default to an ENSO. The other requirement of an ISO is that it has to be exercised within 3 months following the termination. So sometimes what you'll see is that companies will grant an option with a post-termination exercise period that exceeds the 3 months. That is fine from an ISO perspective. The option will still qualify as an ISO, even though the individual has the ability to exercise beyond the 3-month period. However, if that individual exercises 1 day after the 3-month period, then the option will default to a non-qualified stock option. Also, something to just bear in mind is that because incentive stock options have to have these very specific requirements, if you make any or certain amendments to the options after the time that they've been granted, though depending on the nature of the amendment, it could be considered what is known as a modification under the tax rules, which will cause the option to lose its ISO status. So in the post-termination option exercise period example I was talking about, it would be fine to build in the longer post-termination exercise period at grant. But if you decide you're going to grant the option, it will have 3-month post-termination exercise period, and then 2 years from now, you decide actually 3 months is too short, we're going to extend it to 1 year for this employee. Well, that extension of the exercise period will be treated as a modification under the tax rules. So you effectively treat the modification as the grant of a new option. And if your exercise price or your fair market value has gone up since the option was granted, your option will fail to satisfy the ISO requirements because it's treated as a new grant, and on the date of this new grant or the modification, the exercise price of the option will be less than your fair market value, so it will default to a non-qualified stock option. So just something to bear in mind if you want to make any amendments or changes to your ISOs.
So I have a question, Jessica. Since
Sure.
the ISO plans have so much requirements, how common are these plans as opposed to just regular non-qualified plans that are more flexible?
Very common. It's a good question. I mean, very common. I would say almost all plans in the US allow companies to grant either ISOs or non-qualified stock options. And then a lot of companies still continue to grant incentive stock options. And the reason being is that if done correctly, which is a big if because of all of these requirements we've been talking about, and if the individual exercises their option in advance of a liquidity event, there can be very significant tax savings to that person. So if you exercise a non-qualified stock option, you would pay ordinary income tax at the time of exercise on the difference between the fair market value at that time and the exercise price. And then when you ultimately sell the shares that you acquired on exercise, it would be cap gains. For an incentive stock option, if you exercise the option and you hold those shares for the longer of 2 years from the date of grant and 1 year from the date of exercise, that is known as a qualifying disposition. If you hold those shares for that period of time, then there will be no ordinary income tax when you exercise the option, and the shares will be eligible for cap gains treatment when you ultimately sell them. So the tax savings for an ISO could be huge, but as you correctly pointed out, Shira, like there are so many requirements that have to be satisfied in order for an option to qualify as an ISO. Plus, the individual actually needs to exercise their option. So they have to come out of pocket to pay the exercise price. And at least in the US, in most change of controls, options are just cashed out, meaning they're canceled for a cash payment. And in that situation, all options, whether they're ISOs or ENSOs, will be taxed at ordinary income tax. So even though they're very common, I think as a practical matter, most companies or most employees do not get the benefit of the beneficial long-term cap gains treatment for ISOs. And just the last point to flag on this for 10% stockholders. So if you have a founder that holds 10% or more of the company, in order for their option to qualify as an ISO, the exercise price needs to be at least equal to 110% of the fair market value on the date of grant, and the option needs to have a 5-year term, not the standard 10-year term. So what we actually see is that founders or significant stockholders will typically just get NSOs because having an option with a 5-year term that cannot be extended is generally worse than just receiving an NSO that will be out there for at least 10 years. Okay, so we've spoken a lot about options, just moving to restricted stock. As Shir mentioned, there are a lot of tax benefits to granting restricted stock. Most companies will grant restricted stock really at the beginning, at the outset, when they're just starting off. They'll grant it to their founders and their early employees. And then as they continue to grow, they'll switch to options and then eventually liquidity contingent restricted stock units. So the benefit of a restricted stock award is that it allows an individual to make an 83B election. And that is basically the election to pay ordinary income tax at the time of grant. If you don't make an 83B election, then you will pay tax when the restricted stock vests. And if the company is doing very well and the stock is increasing significantly, then your tax bill will continue to increase as the stock vests. So we almost always recommend for private companies, at least. Public companies are a little bit different because you can sell the stock on an on the open market and you can get liquidity to pay your taxes. But for private companies, when someone is receiving an 83B election, receiving restricted stock, we recommend that they make an 83B election. The benefit of an 83B election, as I said, is you pay ordinary income tax at the time of grant when your fair market value is probably very low. It's likely par value. And then it starts the clock for your long-term capital gains. so that when the shares are ultimately sold, you'll pay capital gains. Even though restricted stock is most typically granted when a company is just starting, we do occasionally see later stage companies grant restricted stock if they're bringing on a new CEO or someone of the a member of their C-suite, and they really want to try and structure something that is very tax efficient. And in that case, they will loan the individual the money to either purchase the stock or pay the taxes for the stock. In the US, in order for a loan to not be taxable as compensation, it needs to meet several requirements. So, for example, it needs to have a term, it needs to have a payment schedule, interest cannot be less than the applicable federal rate, which is a rate that is published by the IRS. It cannot be forgiven, and it must be documented in a promissory note. So it's almost as if the loan from the company needs to be as if a bank loaned you the money. And if you do it that way, then it will not be taxable to the individual as compensation.
You can't loan the money to pay the exercise price to the employee and then forgive the loan.
Correct. Because if you do that, the forgiveness of the loan will be it'll be taxable, be imputed income to the individual, and so they will have to pay tax on that.
Okay. So how do we do this 83B election?
Okay, so great question. So we can move to the next one. So first thing that's important to bear in mind with respect to the 83B election is timing is everything. The election has to be made within 30 days following the date that the restricted stock is granted to you. This is a strict absolute deadline. Late elections are not permitted, and there is no ability to extend the deadline. So it's super, super important to make it within the 30 days. As Shira mentioned, up until recently, you had to make a paper filing via, mail to the IRS, which was just really old. It was cumbersome, and people really disliked it. So finally, within the last couple of months, we have now moved to electronic filing. So you would go ahead, you would register an account with the IRS, and then you could go and make your 83B election electronically, which is great. And if you do that, you still need to submit a copy to the company, and you'd also need to keep a copy for your records. It's the same process that you would follow if you were making an election via mail. And so we strongly recommend that if you are receiving a restricted stock award and you're a US taxpayer, or will be providing services in the US, then that you make an 83B election. If you fail to make the 83B election within the time, the 30-day window, the consequences is that, as I mentioned, the tax you will pay tax when the restricted stock vests. The question that I get very frequently is, okay, I missed my 83B election. Can I just rip up my restricted stock award and then grant myself a new restricted stock award and make an 83B election within the new 30-day window? And the answer is generally no. Two reasons for that is, one, that transaction is likely to be viewed as a sham transaction by the IRS and will likely not be respected for purposes of your 83B election, because the IRS will know that you just ripped up the award only to be able to make this election. In addition, what often happens is that companies or employees realize a couple of months later, when the fair market value has increased, that they did make an 83B election. And in that situation, it's often not, well, it may not be tax efficient to make an 83B election then, because the fair market value has increased. And so any taxes that you would be paying would be more than de minimis. So there is a very technical way to potentially fix it, which is basically, and I won't get into too many details because it's very technical, but to lift certain transfer restrictions on that restricted stock. And we have had certain companies in the US take advantage of it. So if you are aware of any missed 83B elections, we're happy to talk about the potential ways to fix it, to see if there are any solutions for that.
I've collected a few questions. Do you want me to?
Sure.
Okay, so what happens if I accelerate an incentive stock option? Is that create a some issue?
Well, it's a great question. So, it could create an issue for your $100,000 limit that we're talking about, because that limit basically says that no more than $100,000 worth of options will vest in each year. So if you accelerate an incentive stock option such that you exceed the $100,000 limit for a particular year, then any excess will default to a non-qualified stock option. So it's fine to include your accelerated vesting provision in the grant itself, but with the understanding that if you decide to accelerate it later on, you could blow your ISO status for that option.
Okay, another question is, can I transfer my ISOs as part of a divorce procedure?
It's a great question. There are limitations on your ability to transfer ISOs except to certain trusts. And so I'd have to go back and refresh my recollection on whether you can do it in the context of a divorce, but it is something that would need to be double checked just because there are restrictions on the ability to transfer an ISO. ENSOs, you have far more flexibility, but ISOs, there are rules, and I would just need to remind myself if you could do it for a divorce proceeding.
And someone is asking, what are the applicable rules if I am an Israeli citizen living in Israel, but also have a US citizenship?
Ah,
Does 409A still apply to me?
well, in that situation, you would likely be considered a US taxpayer because the US taxes individuals on their worldwide income. So because of that, I would expect you would be a US taxpayer. And so a lot of the rules that we've been talking about for US taxpayers would likely apply in that situation.
Okay.
Okay, great. Okay, I'm just checking the time. Okay, I think we're a little bit over, right, Cher? And I'm happy to keep going, or
Let's go over 8 and 9, I think. 8
okay.
and 9.
Okay, yeah, 8 and 9, because we okay, that sounds great. So departures, accelerations, and post-termination exercise period. You can accelerate the vesting of an option. If you decide to do it, you need to do it before the termination date of the individual, because the moment the individual terminates employment or services, generally the way that it works is that the unvested portion of their option expires, or their equity award expires and forfeited, and it cannot be revived. So any accelerations of equity must be done prior to the date that the individual stops providing services. You also need to get board approval for accelerating vesting in the US. So that's something to factor into any timing. In the situation where you failed to accelerate the option, and so, or the equity award, and so you wanted the individual, and now they've forfeited the entire award and don't have the ability to benefit from it. At least in the case of the option, what some companies will do is they will allow the individual to purchase the shares at a discount. You do need to review your corporate governance documents to make sure that this is acceptable, because there can be restrictions on your ability to sell shares at a discount. And then the difference between the fair market value on the sale date and the purchase price will be taxable as ordinary income. So it doesn't work perfectly, but it is an available alternative if you fail to accelerate the vesting and the equity award was forfeited. We spoke a little bit about this, which is the post-termination option exercise periods, whether or not they can be extended. The general rule under the tax rules is you cannot extend it beyond 10 years. If you extend the post-termination exercise period after the time the option has already been granted, as we mentioned, it will convert to a non-qualified stock option. And because of this, because it will convert to a non-qualified stock option, which generally has less favorable tax consequences than an ISO, the ISO holder needs to consent to that extension.
And what happens if I don't get their consent to the modification?
So in the US, typically there is a provision in our equity plans that says, the company has the flexibility to amend or make modifications to their plans or the award unless there would be unless the amendment would materially adversely affect the individual. So there would be a technical violation of the plan terms, and I guess someone could bring a claim against the company for doing it. But as a practical matter, you would, an individual generally would like to have an option that they have a longer period of time to exercise, even if it's an ENSO, then have no option at all. So I think practically the risk is probably low, but there is a theoretical risk that you will have violated your plan terms and someone could bring a claim. Okay, and the last slide is liquidity contingent RSUs. So this is an RSU which vests both on service and a liquidity event. The liquidity event is typically an IPO or a sale. And in the case of an IPO, where the shares will be subject to a lockup, the shares will typically be delivered after the 6-month lockup period extends, but for tax reasons, they cannot be delivered later than March 15th of the following year. So these these restricted stock units need to satisfy Section 409A of the code. And one of the key requirements of that is that the RSU cannot have a term that's longer than 7 years from the date of grant, meaning that if there is no liquidity event within that 7-year term, the RSU will expire. And while in theory you could extend the term of the RSU, you're likely going to trigger adverse tax consequences to the RSU holder. So we generally do not recommend that. Instead, what's common is that if there has not been a liquidity event within the 7 years, you grant the individual a replacement award in the form of new RSUs or an option. You don't want the replacement awards to be identical to the award that they forfeited, so you may change the vesting schedule, the number of shares, etc. But that's generally the way to deal with a liquidity contingent RSU. And most private companies grant these awards later on, when their fair market value is very high, and it doesn't necessarily make sense for them to grant options because no one is going to be paying the exercise price because it's so high. And the last slide, which I don't think we need to cover because we talked about it, is just we spoke about the securities exemptions that you need to comply with at both the federal and the state level. So with that, that's the end of our presentation. I know we ran over, so I very much appreciate everyone's patience. And thank you, Shir, for setting this up.
Thank you, Jessica. Always a pleasure. And I'm gonna send all of the participants our details in case anyone else has questions that they want to ask us offline. So feel free to do that. And have a great morning/evening.
Thanks, everyone.